let's go to the risk radar. Let's talk about gold, which has been pretty far out on green for a while. I don't have an algo for it. The chart just always looked good. It seemed to work no matter what. There it is. Maybe it should have been fully out on the green, but it's been green throughout the duration of this graphic and this style. So the other things haven't changed. The dollar I mentioned yesterday, that's back down again after firming up. Bonds still bouncing around. So the range-bound nature of the macro hasn't changed at all. Stocks still green as well, even with a little pullback here. If NVIDIA softens up more, if chips break, maybe I'll reconsider for that. And Bitcoin there with cryptos drifting into the red, but not yet. Still yellow after putting up a fight here in the last 24 hours of MicroStrategy and Bitcoin firming up a little bit here today. Well, not Master, but Bitcoin did. Coach Scott Bauer with us from Prosper Trading Academy to critique the radar and talk some gold. Scott, I mean, the number one thing that stands out to me today is gold. The reason it's been green on my radar forever is because it seems to work in any environment. I don't know how to describe this environment right now that we're in, but gold seems to be working in it too.
Yeah, for sure. Risk on, risk off. You know, it has not mattered for the last 6, 9, 12 months. And the way that we have approached it, and we have been in and out of the GLD trade the entire year. I think we've actually here at Prosper, I want to say we've had over a dozen trades on. This has been the ultimate buy the dip. There is no question about it. For whatever the fundamental reasons are, and there's definitely a disconnect from the way gold is trading to how it historically trades in relation to interest rates and, you know, geopolitical concerns, blah, 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 blah. This has been the ultimate buy the dip. Now, full transparency, we were in another long position, which we exited out of last Friday. Obviously, if we would have held it through the weekend and at least got the move yesterday, it would have been even that much better. It was still a monster trade. So this is a situation, Oliver, where sure, you can look at all the charts you want. You can be the most savvy, fundamental, disciple of gold. It doesn't matter. It doesn't matter right now. This is buy the dip until it's not.
Yeah.
So, you know, if you pull up a GLD
chart,
we're
on it. Yeah, we're at 328 right now.
Exactly. So for me, what would be the next buy the dip? Well, it's probably this gap that happened from the weekend to the open yesterday. So I'd be looking at probably the 318 area in GLD. Now, that's $10 away. It seems like a lot, but man, we were just there, 2 days ago or yesterday. So that would be an area I definitely have an alert set that I would take another long position there. That is the buy the dip. I mean, this has been, honestly, it's been flat out the best trade of the year.
Yeah, the 318 basically where it kept getting rejected from. I just put a line there to show where the bottom of that gap is. And that I was kind of thinking the same thing too, because technically my new risk radar has got different spectrums of color, and there's like bullish and then uber bullish, and technically gold is bullish. So I was thinking today, like, all right, when would I get super bullish on gold? And I think you just answered my question, which would be if it pulled back into 318, then you gotta, love to take a stab at the old resistance turning into new support. Do you think there's any macro message in this, Scott? Because I'm not a big believer that gold is pure risk off. It's somewhere in between. It's like a hybrid. It might tell us there's more risk off coming.
Right. I would say for the last year, it's hybrid. There's nobody that can prove to me that this has been a safe haven or a risk off trade over the last year. Like I said, historically, its relationship with rates, its relationship with the dollar, its relationship, with macro headlines. Nothing matters. Nothing matters. You go back in gold, and again, I'm gonna just focus in on GLD here. You go back to basically last December.
Okay.
When GLD was 240-ish or so, and if you look at that chart. You made money on every single pullback.
Wow, it's a straight line. It's crazy.
It's crazy. And again, at some point, it's going to stop. at some point it's going to become so overbought that we probably will see a significant pullback. But using options, every time I put a trade on, I know what my risk is. So if we get to that point and it doesn't work out at that point, okay, great. So I would have, the one losing trade out of the other 15 that we've killed it so far this year. But
Yeah.
again, if you want to trade gold based on fundamentals here, you might as well just not trade it.
Do you feel the same about SLV and silver? And I'm going to start with the 2 year chart because the comparison there is a lot more chop throughout the last couple of years. But if we come back and zoom in, I mean, I know that a lot of people have been waiting for this to catch up. And Pete was pointing out earlier some call buying with some pretty strong conviction. This one to me is always trickier. It feels like anytime I've tried to get into silver, I've mistimed it, and I just regret not putting that
Yeah,
money into gold.
totally. And I think we've taken, honestly, this year, 2 SLV trades. Sure, it has the same kind of trajectory as GLD, but I wouldn't say it has been as consistent. You're right. It's been a lot choppier if you look at it. So, sure, if you put up a 50-day moving average, if you can on there, you can see that over the last 6 months,
Uh,
that has flat out been a signal to buy on the 50-day moving average,
okay.
including the last time it hit there, which was about 3 weeks ago on the 19th of August. It was down at 34, and here we are, 10% higher.
Uh,
But it has been a trickier trade than GLD.
for sure. Okay, speaking of tricky, let's go brass tacks here. Let's talk stocks. I don't want to like make a big deal out of nothing, and I just feel like just by saying that I kind of am. But I'm a little bit surprised there wasn't a better bounce back today in Nvidia or the chips. Nvidia down 40 bips. SMH actually coming back to almost even. That's not bad. So I guess we did buy the dip on that earlier today.
This is a tough one because if we look again historically at these cycles and at the sell in May and go away, and the September effect, and the January effect, and all those cycles where over time there has been a really strong pattern of how the market has reacted. Well, 2025, we haven't seen that.
Hmm.
First one, obviously, the big dip in April, nobody expected that. Great comeback. But if you look at the sell in May and go away, if you did that, you got clobbered. And there were a
Right.
couple other times like that where historical trends would have said, the market's going to sell off, and we didn't. I'm not going to say that we're going to end September higher because we know that September historically is the worst performing month of the year. But given these trends that have been broken this year and how the market has defied, whether good, bad, or indifferent, how the market has defied everything that's been thrown at it, you can't count it out that we're going to end this month higher. And
Okay.
the bottom line for me is, Oliver, and you've heard me say this, and I preach it to all my students all the time, is you want to stay long in the equity markets? Great, do so. But buy that protection when you can. Now, the VIX, it's down, 70 bips today.
Yeah.
So historically, it's
Pretty
pretty
cheap.
cheap. It's not as cheap as it was a week, 2, 3 weeks ago, right? But it's those opportunities when you get to buy that cheap insurance that allows you to stay long in the market. And
Okay.
you hope when you buy that cheap insurance that you don't ever have to use it, right? And
Uh,
so you give back a teeny little bit of what your upside potential would have been. Great, fine, that's good by me. So I think we're still in that zone here that, I would cautiously stay overall long in the markets, but you got to have some
feel ahead.
downside.
Let me ask you this, Scott. I'm always tempted by the betting on just a big move. I'm always kind of tempted by the long straddle or strangle,
Yep.
depending on how you want to do it. And a lot of times those are expensive trades that are essentially kind of timing trades. But connecting it with the top of the show, because Brent Kochuba was talking to us about how cheap calls are too. I mean, I wondered if that kind of spidey sense I've got in the market, maybe this gold thing is just we're getting a big move coming no matter what. Give me a 60-second thought. Do those trades suck or are they decent sometimes?
No, they don't suck. And you're right about calls being expensive. If you look at the skew in the S&Ps and the ES, whatever it is right now, it is massive. Where like 10% out of the money puts are so much more expensive than 10% out of the money calls.
Exactly.
I love trading strangle swaps. What does that mean? It means I will sell a near-term strangle, whether it's this week, a week out, 2 weeks out, and buy one further out. So I always want to have that protection. I don't have as big of an outlay of just buying that expensive strangle. So I like to do those swaps when volatility rises.
It's like a calendar swap. I mean, a calendar strangle.
It is. It's a calendar put spread and a calendar call spread. In fact, I have 3 of those on right now. Salesforce, which has earnings right now, coming out any minute. DocuSign, which has earnings coming out tomorrow. And ZS, which we had one going into earnings yesterday, which we did real well on. So I love those scenarios.
All right, there we go. I think we found some. Hey, S&P's pushed until the close, by the way.
They did.
So
they did. They were about to turn negative, and what are we, 18 higher, 18, 19 higher?
Yeah, almost broke it even on the day, 64.51.
Oh, nice. No, there we go. Yeah, 64.50.
Yeah. Nice little ramp there. There you did it, Scott. You ramped us up.